not, I mean, what are the things that people can do in their business that are so much more than the finances that, give you the ability to charge more money?
Well, the my answer to that is you have to be unique. You can't just do what your competition do. You can't be an accountant and say I give high quality, timely service. Well, that's expected. I mean, everybody does that.
Exactly.
So you have to add value to your client's experience.
Yeah.
Value for an accountant, for example, is not just doing the compliance work, filling in the forms and the tax returns and providing financial statements.
Yeah.
You have to add value by showing the client that you're saving them money, that you're making them money, and you're helping their business to grow and prosper.
Hello, everybody. Welcome to the show today. Thank you for coming. Today we have Doug Hoffman, and Doug Hoffman has a tremendous amount of experience that I tap into every so often. We're actually working on a deal together. And Doug is the tax guy. He's the guy that you go to when you need to figure out, where can we save some money for yourself or the person you're acquiring the company from, or whatever the situation is. So Doug, thank you very much for coming. I appreciate it.
Glad to be here today, Greg.
Well,
Thanks for inviting me.
yeah, of course, of course. You're one of my go-to guys. So
Yeah,
I'm thankful for the connection. Finally, we were a while getting there, but we did
all right.
it.
Glad to be on the team. Glad to be on the team.
Well, likewise. Okay, so I think, the place to start is, your experience. How did Doug get to having all this financial experience and knowledge that he has today?
Well, I started off, of course, I started in college as an aeronautical engineer, believe it or not. And my goal was to work for NASA. But right about my junior year of college, they started to cut back and shut down during that period. So I saw the writing on the wall that I wasn't going to go there. So I decided what to do with my career. I decided that, well, if I can't make rockets and airplanes, why not make money? So I started to go to business school and ended up getting an MBA and worked for Price Waterhouse for a while. And I'm originally from Lake Placid, which they were awarded the 1980 Olympics. And I couldn't resist. I applied for a job with them and got to be the CFO, or at that time it was called controller for the Olympics. And I call that my trial by fire. I was a young man, and either I would do the job well, or I'd probably burn up and destroy my career by quitting Price Waterhouse and coming up here to Lake Placid. Turned out to be successful on my end in the Olympics. And I started a CPA practice at the same time. And as a one-man show, doing it part-time during the Olympics. And right after the Olympics, I bought an accounting firm and never looked back. We now have 4 offices in Northern New York, probably the largest CPA firm north of Albany.
Wow.
And it turned out to be a good ride.
I'd say.
50 years later, still enjoy helping people and enjoy doing the consulting part. I obviously don't do tax returns anymore, but certainly do the consulting and the high level tax planning and strategies.
Mm-hmm. Mm-hmm. That's for sure. Yeah, we've definitely talked, about that. With all that experience, Doug, What do you see out there for business owners? Like, what are the biggest mistakes that they're making in their financial decisions or lack of information that they need to have?
Well, that's I think you said it in the last point there is lack of information. I think that when you look at small businesses, and I'm talking about maybe from startups to $3 to $5 million in sales, the biggest mistake they have is not having the financial information right at their fingertips. They're very poor at getting timely financial statements if they get them at all. They don't have the KPIs right at their fingertips on a daily basis to run their business, and they're flying basically blind. The best example I can get is: have you ever driven a car without a dashboard?
No.
And that's the way they're driving their business.
Yeah.
Blind.
Yeah, absolutely. So, and that's why I believe education is so important, and that's what we're doing here is but here's the problem I find is that so many people are reluctant to change or to understanding why they need to know these things. And what would you say to somebody that's listening that says, oh, well, it's been running this way for 30 years and, there's money in the bank. Why do I need to, worry about those sorts of things?
Well, there might be money in the bank, but you can have money in the bank and still be losing money. And especially if you're a sophisticated business dealing in more than one product or service, you could be losing money on one service, making money on the other, and then netting out half of what you made on the good line when you deduct the loss. I tell you from an example of, I have one small client that runs a repair shop in a gas station. And from what I can see, he's making plenty of money on selling the gas, but he's losing it on the repair business because exactly what we're talking about. He doesn't do financials. He doesn't know for sure whether each mechanic is paying for themselves. Each mechanic is their own profit center, and if you don't have the numbers at your fingertips to know, hey, is this guy doing well? Isn't he? Is he not doing well? And the combination of all the service people, is the service department doing well? He has no concept, but I can tell by doing the tax return at the end of the year, he may be losing money in that area.
Yeah. Yeah. So is it fair to say that aside from all our beliefs and thoughts about money, that maybe it's just a measurement tool of how your business is doing? Is that a good way to sum it up?
Yeah, it's a measurement tool, and it's certainly a barometer or temperature of each segment of your business.
Right, right. So kind of what I'm hearing there is that and economics and financial, you always hear about diversify, right?
Mm-hmm.
Diversify just because the basics are that, if one thing starts to decline, another will, stabilize or increase, which will help stabilize the whole thing. Is that something somebody should be doing within their business too, within a small business or mid-sized business, is diversifying their offer to their clients?
To an extent, I've seen people that diversified too much and got out of the area that they know into the unknown areas and lose their shirts because of that.
Right.
But certainly diversifying is very important. It's also important to know that you may have gotten into business because you had a better mousetrap, but as time goes on, that mousetrap gets old. And if you read the book "Who Moved My Cheese," you've got to know when the cheese is moving and where to go from there. And a lot of people don't. and so it's more than diversification, it's innovation.
Hmm.
Keep up with the market, and always ask from your customer or client's point of view, what's important to them, what do they need that somebody else isn't providing that you could provide, and
Yeah,
what answers do you have to their problems that they can't find elsewhere.
yeah, absolutely. Yeah, I'm guilty of that in the past where, I assumed that the market wanted something, but they didn't, and
Hmm.
it didn't work out. So
Yeah,
yeah, that's smart, asking people what they want instead of just assuming, right?
yeah, that's painful when you find out the hard way. It's not
Yeah.
what they want.
No, it isn't. And we always are so certain that that you're right, but that's the beauty of the market. It'll always tell you.
Yeah,
Yeah,
one way or the other. Yeah.
yeah. Won't put their money into it if they don't need it or want it or believe in it.
Right.
So when somebody starts a company, what kind of entity should they utilize? There's sole proprietors and corporations and all this stuff. What kind of when you're just getting started, like is there a point in time where you go from sole proprietor to corporation, or do you start right off in a corporation? What is that?
I always tell my new clients, the startups, to keep it simple in the beginning, unless their projections show that they're going to be uh, hitting big profits right out of the gate. I said, well, let's wait and see how you do. And to me, the sole proprietor is the best way to start out. Now, if you want legal protection, start off with an LLC, a limited liability company,
Hmm.
because that is what I call a chameleon. You can change stripes on that. And that's probably the best legal entity to have these days. Um, 30 years ago, that didn't exist. But
Right.
now it does. And the reason for that is the LLC can be any of the three. It can be a sole proprietor, it could be a partnership, or it could be a corporation.
Oh,
And and so you can gravitate up the line as you get more and more successful. Uh, so starting out and keeping it simple, you form an LLC,
yeah.
you become a what they call a disregarded entity, which is taxed as a sole proprietor. It goes right onto your 1040 as a Schedule C. It doesn't require a balance sheet, and it doesn't require a separate tax return. And so, for an accountant, uh, that's the simplest way to put it on your tax return. It's the cheapest way for the client because it doesn't require an extra tax return. So AISS, keep it simple.
Absolutely. So an LLC, is that hard to start? What do you do? Just go down to the registry office, or can you do it online? How does that work?
Well, yes, you can do it yourself online, or you can hire a lawyer and have legal advice as you do it.
Mhm.
In New York State, it does require some extra steps than other states don't require. Apparently, the newspaper lobby got a hold of the legislators and said that, all right, when you form an LLC, you have to publish it in three different papers, so they get their kickback on advertising.
Huh, I see. I
um,
see.
so but once you form that, you should have an operating agreement. You may need a lawyer to help you prepare that,
Yeah.
or you can do it online and get it done.
Okay.
Now, the thing with a sole proprietor is once you get the LLC, if you don't have any employees, you don't even need a federal ID number because you just simply use your social security number.
Oh, okay. S-
Once you go up the ladder, then you can apply for the ID number later on. But you're right in business once you have the LLC.
Okay.
And as you get partner, as you get employees, or if you take on partners, then you can get the ID number later.
Yeah. So a person's name would be registered to that LLC. Is that correct?
The person's name would be a member of that LLC, which is equivalent to a stock owner or a partner.
Oh, okay.
And their name would be associated with the formation of that LLC,
Hmm.
or the lawyer would be. But other than that, there's that's the way you get associated with an LLC, is becoming an owner, or they're called members
Right.
of the LLC.
So does that LLC protect you if you're going to get sued? Let's say you're sole proprietorship within that LLC. Does that protect you, or does it change at some point?
Yes and no. It protects you from liabilities of the LLC, um, as long as you didn't guarantee any of it personally. But when you say, does it protect you if you get sued? Well, if you're providing a service and you're the one that provided the service, they can sue the LLC and they can sue you personally.
Okay.
So an accountant or a doctor or anybody, a carpenter, if they're actually doing the work, then the LLC is going to protect them personally if you're sued for malpractice or negligence.
Right. Right.
A
Okay.
smart lawyer can sue the LLC, you, and all your kids and everybody.
Oh dear. Yeah.
But it does provide protection somewhat, and especially as you take on employees and partners, then it does, because if you didn't do the work and your partner did it, then they can sue the LLC and your partner, but not necessarily you, because you weren't negligent.
Oh wow.
So
Okay.
that's where you start getting the protection of
Okay.
the LLC. And of course, you have liability protection all along. So there is protection there. It's just you have to go with your eyes wide open and
Yeah.
know when you can be sued and when you can't be sued.
Yeah, absolutely. I would say yeah, there's so many mistakes to make in business, and that's why you go to people like yourself where you've been there, done that, and for example, I haven't. So I'm always open to I have to learn. I have to listen to you because um they you just can't see around corners that you haven't been around. So then I'm going to jump down on the list here, the stock sale versus asset sale. And we had a little bit of a disagreement on that. Not that we were feuding or anything, but I just mean that I had a different perspective on it than you.
All right.
And I'm curious about let's talk about that. Let's talk about stock versus asset sale. What is that exactly?
All right. When you're buying a business or selling your business, you want to look at both angles. Do you sell the stock, or if it's an LLC, do you sell the membership of that entity? And from a seller's point of view, they would prefer a stock sale because it's all capital gains in the U.S. and rather than an asset sale, because in an asset sale, they're going to have ordinary income and capital gains depending on what assets they're selling. And not only that, but if there happen to be a C corporation, there's what they call a double taxation. The corporation is going to have a gain on the sale of that asset. Then the money's trapped inside the C corporation, and to get that out, you have to either liquidate or dividend that money out. And so that's the second layer of taxes, is your personal income tax on that distribution.
Mm-hmm.
So from a seller's point of view, they would prefer a stock sale. From a buyer's point of view, if you buy the stock of a corporation, and especially a C corporation, your basis is in that stock. Your tax basis is in that stock. the assets in the corporation retain their original bases that the corporation had. So if you had uh, a piece of equipment and the corporation had depreciated that down to zero, that's your tax basis. If you had a building and they own that building for 40 years, 39 years, it's fully depreciated. The tax basis is zero inside that corporation.
Mhm.
So the buyer wants to buy those assets separately, not the stock, because then their basis becomes the fair market value that they paid for that building or equipment, and they get to depreciate it all over again
Yeah.
and write it off. So that's why a buyer will want to buy the asset.
Okay, that makes sense. But I will say, and we've talked about this, is that, if I'm the buyer and we know that transitions in transactions is difficult enough as it is.
Mhm.
And if I'm acquiring a company, I see it that a stock or share purchase, whatever you want to call it, is the lesser of the two evils, because I'm not going to have to reapply, for all these vendor relationships. I'm not going to have to hire all the employees again, and there comes a lot of brand value with the stock or the shares. And I believe that it's worth it to acquire it that way. And I think I'm trying to position it also that it's for the seller's benefit as well. So I just wanted to make that comment. And I was just curious what your argument would be. Why, and it's all just, we're just talking right now, we're just
Yeah.
having a conversation, being
Well,
devil's advocates, right?
yeah, if you're going to do that, then you should pay a discounted price for that because you are saving the buyer a substantial amount of money depending on what type of built-in gain they have in that entity.
Right.
And also you have to remember, I mean, your points are valid. You get a turnkey operation at that point.
Right.
Uh, so you have to weigh the value of that to the value of not having that depreciation expense or amortization of the goodwill and the other assets in there. Uh, if that's going to turn out to be a substantial amount of depreciation and amortization each year, that's going to save you uh, thousands or hundreds of thousands of dollars per year. It may be worth the effort to set up a new entity and set up those relationships.
Right.
And it may not be. So you have to weigh the difference there.
Yeah, and that's the stuff that you don't learn about in any book, or unless you're doing it, to know, like, how do you weigh those nuances of, you know again, back to the disruption within the corporation. There's already going to be change.
Mm-hmm.
And not that I'm there to change things, but they know that something's going to change a little bit. My goal is to completely keep everything as best as I can, right? But there's going to be
Now,
some change. So I'm trying to eliminate um
it,
that shock, I guess.
yeah, the other thing you have to consider when you buy the stock of a corporation rather than the assets is that there's contingent liabilities in any organization that once you buy that stock, you inherit those contingent liabilities. So
Yeah.
any warranties or product defects or anything that could raise their heads as far as a liability issue goes,
Yes.
uh, that's the hidden danger of buying a corporation rather than buying the assets or
Uh,
even a partnership. I'm saying corporation, but this would apply to uh, a partnership too, or an LLC as a sole proprietor.
yes. Yes, absolutely. I agree with that, and many lawyers have brought that point to my attention.
Mm-hmm.
And I also think, if those liabilities do come up, what are you going to say? And let's say that that happens in that situation, you're going to try and take care of that the best you can anyway.
Yeah,
Right.
you can take care of that by not paying cash for the stock and paying it over time. And if any contingent liabilities come up, you can offset the installment sale.
Oh,
So that's one way of covering that. One thing I want to correct is that if you buy a partnership or sole proprietorship,
yes.
you can step up the basis of the assets after you buy that. So I just want to make sure that the listeners understand it's
Yeah.
only a corporation that you get stuck with not being able to step up the basis of the assets if you buy the entity.
Okay, so if I buy the entity now, does the S corp and C corp come into play here when you're buying the corporation shares?
No, not from the asset revaluation goes. Both an S corp and a C corp, you're stuck with the assets as they are in the organization if you buy the stock.
Okay. Okay. So can you you can't change that. You can't change S to anything else?
Well, yes, you
Or
know,
C, excuse
I'm
me.
just saying that in this one particular example of buying the asset versus the stock,
Right.
in S corporation, you can terminate at any time. In a C corporation, depending on whether or not it was an S corporation in the last 5 years, you can elect to be an S corporation at any time. But S corporation has limitations. You have to have less than 100 stockholders, and you can't have any non-resident foreigners as owners.
Okay.
They have to be resident aliens or U.S. citizens,
Okay.
and you cannot have other corporations as owners either.
Okay. So that's the S corp, right?
That's the S corp.
Okay. So the S corp, you got to have okay, so when you're making the decision to go from sole proprietor, so none of this applies in the LLC then?
Yes, it does. It's
It does.
same restrictions
Oh,
as
okay.
to when you can become an S corporation.
Okay.
But if you're disqualified from an S corporation, you're automatically a C corporation.
Oh, okay.
So you can go up the ladder. You can go from sole proprietor to a corporation. Then you decide whether or not you want to be a C or an S corp.
Okay. Okay.
And you can go from a sole proprietor, bring on a partner, and then from the partnership, you can become a corporation or stay as a partnership.
Yeah. Okay. Okay. All right. Well, lots of decisions to make on the way through, right?
Yeah,
Yeah.
yeah.
So, okay. So, and then what are the taxation, benefits that come along with, going from sole proprietor to LLC or and then S corp or C corp? Is it a benefit to the shareholders or is it a benefit to the corporations?
Well, the big benefit is that if you go from a sole proprietor or partnership to a corporation, again, you decide whether or not you want to be a C corp or an S corp. The C corp is recommended if you need to generate internal capital to grow, or if it's a startup, if you need a lot of capital to start, because the C corp under today's laws, their tax bracket is a flat 21%. So if you look at an individual will go from 0 to 34%. So somewheres along the line, if you're making, off the top of my head, say $150,000, you're exceeding that 21% corporate rate, and so you're paying more individual tax.
Okay.
Now, as a sole proprietor and partnership, if the owner's active in that business, they're also going to pay self-employment tax. which right out of the gate is 15.3% up to $160,000. And then it's 3.8% forever over and above that.
Oh, okay.
So you have that layer of tax for a sole proprietor and a partnership.
Mm-hmm.
When you get into a corporation, the Social Security tax is only on the wages paid to the owner, not the profit.
Right.
So that's the advantage of thinking about becoming a C Corp or an S Corp, is that you can limit the amount of Social Security and Medicare tax that you're paying.
Mm-hmm. Mm-hmm.
And it's not 100% on the profit that you're going to be taxed that extra tax.
Right. Right. Okay.
And so that's when you start. I usually start looking at it when clients start making more than they need to live on.
Okay.
And generally, because once you become a corporation, if you're taking a salary out, IRS looks to say, is that a reasonable salary?
Mm-hmm.
So especially when an S corporation, they look very closely at that. Is that a reasonable salary for your profession? So if you're a doctor and a reasonable salary in your profession is $300,000, you can't pay yourself $25,000 and eliminate Social Security tax.
Mm-hmm.
You got to pay at least the reasonable. If
Yeah.
you're a carpenter and a reasonable salary is 40 or 50,000, then yeah, that's what you can pay. And if you have another 50 or 100,000 in profit, you can argue that that profit is on the business, not your labor.
Mm-hmm. Mm-hmm. Okay. So one way or another, we got to pay.
Yeah, well, you got to pay something, but it's got to be reasonable.
Of course, of course. I ventured down a path at one point with a guy, Brian something, and I should have had this prepared, but it just came to me. There's this tax strategy where they utilize, I think it's insurance, where you loan the money. Like if I was gonna acquire a company, right?
Mhm.
They would they have this loop. I don't know if it's a loophole. I don't want to call it that because it's not illegal.
It's
So
called tax planning.
it's questionable, right? Tax planning, yeah. So they would give a loan to the person that you're buying the company from, so that they get taxed less because you can't be taxed on a loan. Is that Have you ever heard of anything like that? Where instead of it being income from the sale, it's actually you're loaning the money to the person that you're buying the company from through some kind of instrument. I'm not exactly sure, but what I'm wondering is that is that questionable by the IRS?
Well, you better have some real tight documents because the IRS is going to look at the facts and circumstances in any transaction and determine whether it's a sale or not a sale.
Right.
So if you loan the person the money and then you take possession and control,
Mm-hmm.
that in itself could dictate that it was a sale.
Right.
And so when they look at the underlying facts and circumstances, they may see through the disguise.
Yeah. Yeah. Fair enough. And yeah, the Mike, it was questionable. I mean, and this guy is doing it for people, and that's
Mhm.
okay. Anybody that I was working with that I presented it to was just they were like, the IRS scares me, so I'm just not going to touch that. So I kind of just dropped it because it wasn't beneficial to anybody. Everybody was.
Yeah, like I said, if it you know the 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 taxpayer is ultimately responsible no matter
Yeah.
what the advice is, and so do you want to be a tax court case and
No.
become the standard?
Exactly. No, I don't. Absolutely. So when it comes to people selling their business, and everybody has a different expectation. Um, we can talk about succession planning in a lot of ways, but I mean, there's this, I think it's a lack of education in the people that are selling their business that somebody's going to come along with a truckload of cash and say, okay, here's your money and we're going to take over now. Has that been your experience, Doug, in seeing transactions happen?
Yeah, unfortunately, first of all, somebody that's built up their business over their lifetime, that's their baby, and there's a lot of emotions attached to it. Number one,
Yeah.
number two, there's a lot of high expectations too.
Hmm.
What they think it's worth and what it's really worth is there's quite a gap there normally.
Yeah.
And the third thing is that a lot of these people that sell their business have no clue as to how much they're going to end up paying in taxes.
Hmm.
And, as much as I preach to my clients, every once in a while there's a client that just sells and then tells me afterwards, I just sold my business. And I said, oh my God. I said, there's a lot of planning that has to go into this. There's a lot of
Yeah.
asset allocations that can save you a lot of taxes in doing this.
Yes.
And, I feel like jumping off a bridge when I hear that they just sold it. And they feel like jumping off the bridge when I tell them how much they have to pay in taxes because they didn't even plan for that part.
Oh my gosh. Yeah. Can
So,
you give us an idea, like what kind of taxes are they going to pay?
well, it's you know, I'll tell you a funny situation after. Well, it wasn't funny; it was really sad. But if you sold a business that you've been in for 40 years and you fully depreciated the assets,
Hmm.
uh, you're going to have depreciation recapture. You're going to have capital gains. You're going to have ordinary income, and the big scope to that is a business like that you could expect to pay between state and federal taxes 30 to 33%.
Oh my gosh.
And it's you've enjoyed all the write-offs, but now it's coming back to bite you because your basis in these assets is zero.
Hmm.
um, I had one business that sold for $3 million, and they ended up paying $1 million in, and the lawyer gave me such a difficult time. He says, "There's no way that they have to pay that much in taxes." I said, "Well, what do you suggest?" You
Yeah,
know,
yeah. I
the
didn't write.
tax basis was zero. Well, you can't be right, and there's no way in doing that. And the guy ended up turning a client of mine for 40 years uh, against me.
Oh
And
my
and
gosh.
finally, I finally told him, I said, well, take it to another accountant and have them go through the numbers. You can
Yeah,
take any accountant,
yeah,
they're not going to come up with anything different.
yeah.
And you know, they didn't. Is the bottom line,
Yeah.
which is unfortunate. Don't shoot the messenger. That's the
That's
tax law.
that's all you were. You didn't write the tax law. I mean,
Yeah.
taxes are
And
taxes.
and the sad thing about it is that I saved them tens of thousands of dollars in doing that, but this lawyer just gave him a poison pill.
Yeah,
He,
yeah, yeah,
he
yeah,
he didn't see what I did do to save him money. All he did was tell him that can't be right.
yeah. Well, sometimes that's business, right?
Yeah.
It's difficult with dealing with other advisory sides of things. That's been my experience, but that's business. Some win some and you lose some. But yeah, sorry to hear that. But
Yeah, I mean, this lawyer was the first to tell you he wasn't a tax lawyer and he didn't know anything
oh
about.
yeah, yeah.
Yet I was wrong. Yeah. Oh,
So
it's sad. It's
yeah.
sad. Yeah.
So what can people do? when it comes to what's some high level things people can do. I mean, you got to prepare for tax, and you're a guy to do that. Um, but what are some things to be thinking about, 5 years in advance to, the day you're going to sell?
Well, that's the best time to get your accountant involved in your tax strategy involved is to look at where you are right now and what you can do in the next 5 years to structure your business for sale, and who are you going to sell it to? I mean, one of the best tax um, legal avoidance law out there is what they call an ESOP plan, an employee stock ownership plan. There is nothing better for a tax strategy than that. If you have managerial employees that could take over your business, you can sell 1/3 of your business to an ESOP plan, which is very similar to a pension plan. Yeah. The company gets a deduction for the interest and principal that they pay on that. Yeah. So you go out and finance it, and the seller can do a tax-free exchange for the corporate stock for U.S. domestic stocks, yeah. Tax-free.
Amazing.
And you can do that with 100% of the company, or you could do it with 1/3 of the company minimum, and work your way up. And the way we've tested it before is we start out with 1/3. We start to turn over the management of the company to the employees, see how they do, and if they do really well, they pay off the bank loan for the 1/3, and then you take out another 1/3 for the bank loan, or you take out the 2/3. Yeah. And and where else can you get a deduction for dollar what you pay for the company?
Nowhere.
And plus the interest, plus the owner can get a tax-free swap. Yeah. And basically hold those investments, live off the dividends or whatever they want to liquidate. Yeah. And hold that until death, and then you get a step up in basis for your heirs.
Yeah, absolutely. It's beautiful. So let's just make that really clear. So I come along as the buyer, and the seller, they're not sure what they're going to do. So I say, okay, well, I'll buy 66% of your company. And we really care about the people because they're our people, and we want to see them do really well. And here's the way we're going to do that. We want to create an equity program, an equity stock program for them, which, as a sidebar, I believe that's where the whole world's going. But that's beside the point. And so that 33% of stock of that company that's being sold gets converted in a period of time to stock on the stock exchange. Is that correct?
Yes, the seller exchanges that stock for domestic stocks on the stock exchange.
Okay.
And doing it properly, it's there's a lot of legalities in between.
Well, of course.
They do not report a gain on doing that.
That's amazing. Wow. Okay. So why wouldn't somebody do that? That's just brilliant. Is there any reason why you wouldn't?
Well, if you don't have the internal management capabilities, that's a big reason that you won't do that, because what happens is the company takes out a loan, so you have to get a bank that's going to finance that. And the bank's going to look at your succession management. Can they actually do that? The second thing is having the employees buy into it. A lot of employees don't understand the concept, and a lot of employees are employees, not entrepreneurs, and
Hmm.
basically don't want anything to do with owning and running a company.
Right, right. Okay, so let's talk about that. An entrepreneur, what's an internal, what'd you say? The entrepreneur?
Yes,
Yeah.
the
What is that?
employees can, is there a management team that thinks like entrepreneurs rather than employees?
Yes.
Because employee thinking won't run a company.
No, that's right. That's right.
Employee wants a paycheck every Friday. They don't understand the risk and rewards of running a company. They
Hmm.
don't understand the innovation of keeping up with the market and the expectation of the market. They don't understand when your cheese is moved and you have to find beef strips.
Yeah, yeah. Do you think, and this is what I think that as a collective, as a group of people, that the reciprocity is going to set in. And, if everybody within the corporation is, okay, maybe not everybody's doing their part, but some are going to see that others are. Um, I think that creates a whole new awareness within the workplace. What do you think, with your experience, which you have more of than I, is that possible?
Yeah, I've seen ESOP plans that turned out to be a disappointment
Hmm.
because uh, you're exactly right. The smart employees start looking around and saying who's carrying their weight and who isn't, and
Hmm.
so it starts to create turmoil. And if that turmoil isn't properly managed, it can eat apart the organization.
Okay.
Um, and also, you know, this particular one that I remember is I was totally taken back at the employees' reaction to this, where I thought it was the best thing since sliced bread for both the seller
Yes.
and the employees.
Yeah.
They looked at it very negatively
Really?
and like, this is a trick, you're fooling me, or and because of the fact that all of a suddenly they're looking at it as, okay, this was worth this much today, what if it goes down in value, what if it, and this is going to be my retirement, and they, unfortunately, not all employees are sophisticated enough to understand the intricacies of running the business and
Hmm.
owning the business.
Hmm. Hmm. Hmm.
And so what happened to this particular business is they did survive, they did pay off the 1/3, but then the owners decided to sell the 2/3 to somebody else because they just didn't see the employee group effectively running the entire 100% of the business as an owner.
Yeah. 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 Very interesting. Wow. Well, thank you for sharing that. Lots to learn. So I
Mhm.
guess you really got to get the management and the communication and the education part right, and maybe that's an ongoing thing. Um, in talking to lots of people, they say that of all other things, communication is the key to successful people in our organizations. Do you think maybe in that situation, I'm not sure, but was there a lack of communication or was there lots of it? Or,
I thought, I guess in retrospect, it could have been better communication,
mhm.
but I also learned a valuable lesson is that sometimes employees are going to think like employees and never change.
Right, right.
And I'm not saying that, I guess I'm saying that derogatory, but that's life.
That is
Is
life. The truth is, yeah.
some people just don't get it. They don't understand that when something like that is handed to you, it's a gift.
That's
It's
right.
not, it's not a burden.
Yeah,
And
yeah. Okay. Well, thank you for sharing that. That's the most valuable lesson. Absolutely. Well, I didn't know that. And for the listeners, if you're listening, listen. So
And don't get me wrong, I would still highly recommend it. But
yeah,
I
well, even
think your comment is maybe a little more education and a little more hand holding could have gotten the employees to really understand what it was all about.
yeah, yeah, absolutely. Yeah, I'm gonna have to definitely put some thought to that. You know what I'm saying.
Yeah.
Um, okay, so some simple stuff, that we've got on the list here. And a question I've always wondered, leasing vehicles or, your liabilities versus owning them. And I've seen both sides of it. I've seen more one side than the other where somebody wants to own it instead of lease it or borrow it. What has been your experience um, in that situation? Like, should somebody buy the piece of equipment outright, or should they put it on a plan?
Well, that the best answer I can get, it depends on each individual circumstance.
Okay.
You definitely want to look at it from both angles. You want to look at it from the economic issue, and you want to look at it from the tax issue. And don't let the tax issue override the economic issue. Um, when it comes to a vehicle expensing as far as depreciation in the U.S. is very complicated. You have so many different classifications of a vehicle. You got the standard vehicle, you have the SUV, you have um, the um, the heavy vehicle greater than 6,000 pounds loaded. Then you have the strictly business vehicle that is not a passenger car.
Mm-hmm.
Uh, and so the write-offs for those are all different, and it depends on the use of it. And then you want to compare it to leasing because the way the IRS allows for depreciation of a standard passenger vehicle, you can write off only so much over 5 years. It goes up with inflation, but I think it's like $35,000.
Mm-hmm.
So if you're buying a car that's more than $35,000, you want to look at leasing it to see if you can write off more than that over 5 years, then you can depreciate because when you look at the leasing, there's an add back. You can deduct 100% of the lease payments, but you have to add back for what they call the luxury vehicle, which is over $35,000 or $40,000 is your standard passenger.
Hmm.
But the add back under a lease is very minimal compared to the depreciation you can't take on a vehicle that costs 50 or 70 or $80,000.
Mm-hmm. Mm-hmm.
So you want to do that. The other thing you want to look at is are you just going to trade that vehicle in over 3 years or 4 years, and then leasing versus buying.
Mm-hmm.
A lot of times the leasing makes sense. Before the pandemic, the value of the vehicle at trade-in time, or when you give it up, it was zero anyway. So
Mm-hmm.
you ended up paying less economically over 3 years than if you had bought it.
Yeah, yeah, absolutely. Okay.
So that's what I'm saying is the economic I usually take first and then the tax second because dollars are dollars.
They certainly are. Yeah, absolutely. Um, my head was going to this when you were telling me about that. It's balance sheets. Um, when it comes to shareholder value, and I understand it's a balance sheet, but I mean, is that shareholder value when it says that on the balance sheet? Is that anywhere related to valuation of a company?
Not usually, not
Okay.
usually, because the balance sheet is equal to assets minus liabilities will give you your capital accounts. But as you depreciate those assets, down to zero, the fair market value of those assets could be much higher than what's shown on the balance sheet. And then you have the intangibles such as goodwill that
Uh-huh.
doesn't even show on the balance sheet.
That's right. Let's
So
talk about that, Doug. Like goodwill. What is goodwill in financial business terms?
goodwill is the going concern value of the fact that you have location, repeat customers, client list. You could have patents and licenses that don't show up on the balance sheet because you built those over the years through your reputation and the fact that people keep coming back to you
Yeah,
because of your name and location.
right.
So so that is something that is they call it an intangible because you can't touch it, but it's there and
Hmm.
it's worth money. And when you buy a business, the excess over the fixed assets that you're buying is goodwill and intangibles. And
Yeah.
what's the value of the business worth? Well, you go to the P&L and you determine the cash flow from that business operations, and then you get into a price earnings ratio that
Hmm.
when you capitalize those earnings, that's the value of the business. And again, you subtract the fixed asset costs that or the assets that you're buying, and the excess is your intangibles, goodwill.
Yeah, yeah,
And,
absolutely. I've seen some
and,
pretty crazy goodwill valuations in my time.
yeah,
You know,
and and included in there is the covenant for the owners not to compete with you once you buy it.
ah, yes, yes. I've seen that. I've seen the downfall of a company
Yeah,
mainly because of that reason. Um,
really. Yeah.
yeah, because they just didn't know. They didn't ask anybody and they just were believing everybody was like them and just not everybody's like them and not everybody's honest and truthful. And what happened was one of the owners that sold out just went down the road and took a lot of the business, you know.
Yeah.
So
Yeah. You,
non-competes are important.
you have to watch out for the employees doing that too.
Yeah, well, there's a ton of businesses that have started that way, you know,
Yeah.
and
Yeah.
and they think, okay, well, I can start a business and do the same thing that this guy's doing, but I can do it better because I do better quality. Um, and we all know just because the circles we're in, Doug, like there's more to it than just doing something of better quality, right? And I mean, with all of the training that we have with focus group and whatnot, I mean, what are the things that people can do in their business that are so much more than the finances that give you the ability to charge more money?
Well, the my answer to that is you have to be unique. You can't just do what your competition do. You can't be an accountant and say I give high quality, timely service. Well, that's expected. I mean, everybody does that.
Exactly.
So you have to add value to your client's experience.
Yeah.
Value for an accountant, for example, is not just doing the compliance work, filling in the forms and the tax returns and providing financial statements.
Yeah.
You have to add value by showing the client that you're saving them money, that you're making them money, and you're helping their business to grow and prosper, and you're helping that bottom line and increasing the profits. Then
Mhm.
you're not costing them money, you're making them money. And
That's right.
if you're making them money, then you're going to have a client for life. If you're just charging them for tax returns and financial statements, it feels like they're going to the dentist.
That's right. That's right. And that's so many business owners, that's all they do. They just do the bare minimum. It's like they're almost like they're thinking like an employee, but they happen to own a business.
Exactly.
So all right, Doug. Well, I appreciate you so much. And I've learned so much and we've got more to cover, but we'll have to do it the next time. Does that sound all right?
Okay. That sounds fair. I'd be glad to do that again.
All right, wonderful. Hey, any parting advice for the financial and business audience that are listening?
Uh, yeah. You know, don't just accept what you're doing. Get information so that you can monitor what you're doing. Don't drive your business without a dashboard, no more than you drive your car without it.
Yeah,
And find somebody that's going to give you real business advice that's going to increase your bottom line, your profit.
yeah, yeah,
And also not only increase your bottom line, your profit, but help you to work smarter rather than harder so that you have more money to do what's most important to you and you have the time to do it.
That's beautiful, Doug. Well, thank you very much.
Okay.
All righty, we'll see you later in the week, sir. I thank you very much.
Okay.
Okay,
Glad to be on this, Greg, and you have a great day.
I will. You too. Thank you, Doug. All
All
right.
right. Bye.
Bye-bye. Hey, Doug, just one second before you
Yeah.
go. Where can people
Sure.
find you? Where can people find you?
Okay. You can find me at hegcpas.com, which is Hotel Echo Golf CPAS.com.
Perfect. I'll put a link in the description as well.
Okay. Well,
Okay.
you can put my phone number in too.
Okay. Oh my God, you answer the phone. Nobody does that.
Yeah, I'm old fashioned.
All right, man. Thank you very much. We'll talk to you soon.
All right. See you, Greg.
Okay.
Bye.